Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Good to be here with you today. I am joined once again by Eddie Ghabour, co-founder and CEO of Key Advisors Wealth Management. And we're going to talk about the latest goings-on in the market, the Fed, inflation, a bunch of different things. So, Eddie, always good to have you here on the show with us. And I know our listeners always enjoy hearing your thoughts. And I wanted to kind of start off by, talking about the small and mid-cap markets. It seems like there's some opportunities in there, given that, we look at large caps and we are near all-time highs on the S&P 500. What's happening right now, and what do you think is going on in these markets here?
So look, we started off a little slow to start the year in the markets, and then of course we have really accelerated, and you're seeing the flows continue to be very concentrated in the mega cap tech names, anything tied to AI. So it's been a very concentrated market. And our thought process for this year is, if this market is going to have another positive year, that you're going to need to see this market broaden out. And one of the areas that we feel has the most upside, if that happens, is the small and mid-cap space. It's interesting, we hit an all-time high in the S&P, and it was the first time in history, I believe in history, because history is a long time, so we can fact check me on this, where we had an S&P at an all-time high, and the Russell 2000 was still 20% off of its all-time high. So that's a pretty wide divergence there. So our thought process is, in order for this market to stay strong, you're going to need to see small cap really catch up. And so we're looking at it as a catch-up trade. We did buy the dip at the beginning part of the year in small caps and mid caps, and we look to continue to add to those areas. So called a contrarian play, where we're trying to put money where money flows have not gone this year so far, because we think we're going to see a catch-up trade, and you'll see money go to those areas, barring anything happening economically that would cause a recession, of course.
Right, of course. And I think, for the most part, our chief investment office here at UBS feels like the recession is behind us. Now we're sort of wondering what inning we're in when it comes to this economic recovery. But we do expect a dovish Fed this year. We're expecting them to start perhaps cutting rates at the meeting in May and have that soft landing that we're all wondering about. So given all of that, and we know the economic backdrop as of today, what do you think could be some of the headwinds for investors right now?
So the headwinds for investors that I think they have to pay close attention to is the dollar. We have seen the dollar starting to strengthen here. And if we get a dollar, if it just stays at this level and range bound, it's okay. But if we start to see the dollar really soar, that would be a major headwind for equities. And then the bond market, right? Interest rates, if you take a look at tech and interest rates, if we get a 10-year treasury start to blow through 4.25 and go to 4.5, that could certainly be problematic. And so when you look at those two things, the third thing that I would say is in regards to growth, okay? Right now, growth is slowing, but not to a point at this point in time that would cause major concern. But if we see a first quarter GDP print and then a second quarter GDP print that really shows some fast deceleration, that would be an area to be concerned as an investor, that growth is slowing at a much faster pace than the market has. So those three things I think are key to this market staying strong and continuing to trend upwards.
Terrific, Eddie. Thank you very much. And, before we go, I wanted to just kind of pick your brain a little bit. When you look out over the next decade, or so, what do you think will be maybe some of the challenges, because there's a lot of debt out there, and consumers, businesses, government, the debt is continuing to rise. Are these elevated debt levels a problem here? What do you see for the next 5 to 10 years or so?
I do. I think this is going to be an extremely challenging investment environment for the next decade. And I would argue that no one alive has seen an environment like this before, where you've seen massive amounts of debt. I mean, and this is across the board, governments, individuals, as well as businesses. And look, I'm old school. I don't think you can borrow your way to prosperity. So as though we're enjoying these equity markets right now, I think investors are going to have to shy away from having, in our opinion, 100% of their portfolio in just a passive strategy. I think you're going to have to be very tactical for at least a portion of it, because I believe at some point in time, probably in the next 2 years, there will be a price to pay for this debt. because you can leverage up as much as you want, but there is always a time that you have to pay the piper. And I am very, very concerned about debt levels, and I think that will cause some major headwinds in certain areas that will cause a lot of twists and turns in this market where post-election, I think you're going to really see a lot of volatility as we go into the next several years.
Right, and I think nimbleness is probably a good key word for investors as of right now. As you said, we're prepping for an election here in the U.S., and then depending on who takes the White House, policy could really shift. So certainly something to think about. Eddie, thank you very much. It's always good to have you join us.